everyone. This is Brandon Garrett with Bent Oak Capital for your June 2021 Economic Update. Please stay tuned at the end of this video for a required disclosure statement. During much of 2020 and early 2021, markets were focused on fiscal policy due to massive government efforts to help bridge the economy past the impact of COVID-19 restrictions. Policy will still matter over the rest of 2021 and into 2022, but it will matter far less despite some important debates going on in Washington. Markets may anticipate an increase in government spending if Congress passes some version of the Biden administration's Build Back Better, or BBB, initiative, but that spending will likely be spread out over almost a decade. The biggest risk may be around taxes, with businesses and wealthy households both facing the prospect of a higher tax burden to pay for the BBB initiative and help manage the deficit. Much of the approximately $5 trillion in direct COVID-19 related stimulus in 2020 and 2021 did not flow through directly as government spending. Instead, the federal government used its borrowing power to distribute funds to households and businesses. That impact will fade over the remainder of the year, but will be replaced by the private economy accelerating. Actual government spending is likely to continue to grow, but the rate of growth will not make a large difference to overall output in our more than $20 trillion economy. But even a small contribution to GDP growth can be massive in absolute terms. With proposals for the two pieces of BBB reaching nearly $4 trillion, higher taxes would be needed to help finance the new initiatives. Let's be clear though, with a 50-50 Senate and historically slim Democratic majority in the House, we think these final numbers will likely come at $2 to $2.5 trillion combined, as these initial numbers from the Democrats were a starting point for negotiations. The negative news for markets is that corporate earnings growth will likely take a direct hit that is approximately equal to the size of any tax hike. Because the stock market is fundamentally driven by earnings growth, the tax impact will likely be a headwind for equity markets. However, on the positive side, this move has been anticipated for quite some time and should not be much of a surprise to markets. President Biden is unwinding some policies of the Trump administration, and President Trump unwound policies of the Obama administration. Neither party has held the White House for more than 8 years since Bush beat Dukakis. Congress has also been hotly contested with more frequent swings. Over the past 40 years, the House has changed hands 7 times and the Senate 4. If you don't like the policy environment, just wait a few years. We'll get a new one. The American electorate is nearly evenly divided right now, fostering more frequent swings and also a certain wisdom in rejecting the excesses of both parties. We've often commented that markets tend to like mixed government, and we may have one not much further down the road. In conclusion, the massive fiscal and monetary policy support that helped the economy and the stock market get through the pandemic is starting to move toward the sidelines. Markets like stimulus and even a gradual move to the sidelines may cause some bumps. But we think that economic conditions, rather than policy, will be the most important driver of the return environment in the year ahead. We are watching negotiations over corporate taxes closely, but if history holds true, tax increases may slow markets, but they shouldn't fundamentally shift the return outlook. U.S. businesses remain agile, and even with potential hit from higher taxes, there will be plenty of opportunities ahead. That's it for this month's video. If you have any questions about what we discussed, please give us a call at 817-550-6750.